Nvidia stock is trading over 16 times forward sales and over 50 times forward earnings. That's after even being down over 47% over the last year. Is this stock poised to bounce back? Is this stock poised to meet those lofty valuation estimates over the next year? We'll talk about that and more on today's show. What is going on, investors? Hopefully, you guys are doing well out there. Time to talk about Nvidia, one of the stocks we regularly cover here on our Friday Fang Stock Recap show. Q3 earnings came in, and we're not going to waste any time. We're going to jump right in. Revenue coming in at $5.93 billion. That was the decline year over year of 16.5%, but it did beat the lowered expectations over at this company by about $110 million. Wall Street estimates for this quarter was closer to $5.8 billion. So this 5.93, not too bad. Now, we also got Q4 guidance for Nvidia as well, coming in right about $6 billion for the upcoming quarter. That's plus or minus 2%. So they'll come either side of that by about 2%. Well, Wall Street was expecting maybe a little bit higher than that, especially if they kind of come underneath that $6 billion range. Wall Street was expecting a number closer to $6.14 billion on those estimates. Now, we got the all-important kind of sector or segment revenue trends for Nvidia. And look, you still had really strong data center. And they also came out a press release today that they were going to put tens of thousands of these GPUs inside of Microsoft's Azure data center. So that should lead to at least some stronger revenue. Maybe the margin's a little bit lower on that type of thing. But data center strong year over year and even sequentially quarter over quarter, we're also seeing growth there. Now, the former number one revenue segment for Nvidia was actually these gaming chips, is spurred by actually two different things. Number one, actually gaming with the chips, playing video games, but also by crypto mining. And obviously the crypto sector has just been obliterated over the last year and certainly over the last week. There's been a lot of developments there. You're seeing a decline tremendously in the gaming sector. But however, their newest chips and their newest GPUs were just released. And so it's actually expected as you roll into kind of a newer product cycle, you are going to have some weakness here and you're going to have some flushing of some inventory. On top of that, you're going to have gamers that are keeping track and staying up on all the latest trends. They're going to wait for these new products and kind of see if they meet their needs. And so we'll see in subsequent quarters if this gaming sector revenue starts to come back. Because look, last year it was at $3.4 billion. That was actually in Q2. Q3 was $3.2 billion, and you've been cut in half down to $1.5 billion. Even last quarter, as gamers were still anticipating the new chips, was still $2 billion worth of revenue. We saw a professional and visualization revenue kind of fall off the map, but you got your automobile revenue start to tick up. But those are rounding errors when you're looking at a company with nearly $6 billion worth of revenue. So year over year, of massive revenue declines, even sequentially quarter over quarter, you are also seeing revenue declines. This company is going to have to hit the ball out of the park over the next 12 months, in my opinion, just to meet these lofty valuations that this company has. Because we're looking at a company with $400 billion valuation, having declining revenue year over year, really for the rest of the year and into next year. And you're looking at a company that's going to do $26 billion worth of revenue. And when we come over here and look at profits, there's not going to be that many of them. When it came to gross margins in the most recent quarter, they were not bad. They were definitely not as good as they were last year. They were at 65%. But again, we're kind of in a product reshuffle, a new season of products, if you will. And so obviously the margins are going to trend down as you're trying to flush out the inventory of the previous year's models. And if you look sequentially, you went from 43.5% up to 53%. We'd expect these gross margins and profitability to start coming back in subsequent quarters. When we look into this quarter, again, you had roughly $6 billion worth of revenue, $7.1 billion last year, higher cost of revenue on lower amounts of revenue from 2.5 up to about 2.7. That leads to lower gross profit from 4.6 down to 3.2. Your research and development ticked up a little bit, but not much, from 1.4 up to about 1.9. They've done a nice job. Look, this company is a well-oiled machine. They haven't blown a ton of it on sales, general and administrative expenses. Those went from 557 up to just 631. So your total operating expenses over the last year grew rather considerably, up from $1.9 billion to about $2.6 billion. Again, that's on lower revenue and lower margins. So that's going to obliterate your income from operations. Look at last year, you had $2.6 billion worth of income from operations. This year, $2 billion lower to $600 million. That's right, folks. On a company worth $400 billion, you print just $600 million worth of operating income in a quarter. That's just not good enough for most investors. Pull all the way down to net income paints a similar story, just 27 cents per diluted share on that APS side. Last year, nearly 4 times higher at 97 cents. When you go over the balance sheet, nothing really to worry about, okay? They got plenty of cash. They do have a lot of inventory, but again, this is comparing to like the end of a holiday season. Also, it was notoriously kind of short on inventory last year and into 2020. They had just $2.6 billion worth of inventory, a little bit higher as you're building in new products as well. So we're not too worried about inventory as maybe we were maybe a quarter or two ago with Nvidia. They have about $4.5 billion worth of inventory. And look, if they're expecting sales to be relatively decent for upcoming quarters, having this inventory, not necessarily a bad thing. Moving down to the liability side, yeah, they have about $9.7 billion in long-term debt. Short-term debt, you're looking at about 1.2, but total liabilities on this company, just $19 billion. They have that in cash, receivables, and inventory alone. So very financially healthy company. Nothing to really be concerned about there. Now, when we come down here to cash flows, we will see, yeah, things have actually gotten pretty bad over at Nvidia. We pulled down a very weak net income number of just $680 million. It was $2.5 billion last year. If you want to look on a 9-month basis, you're seeing this trend played through all year. This is why the stock is down so much, from $6.7 billion worth of net income down to roughly $3 billion. That's again on a 9-month view. You get to add back in stock-based compensation, which in the most recent quarter actually exceeded your net income. Obviously a negative trend, but for cash flows actually benefits your cash flow as you get to add that $745 million back into these. And you get down here to net cash provided by operating Nvidia, and you'll see it's bad, okay? From $1.5 billion all the way down to nearly $400 million. I'll remind you, this is a company that's worth $400 billion, and cash flows from operations in the most recent quarter was just $400 million. Yeah, by most investors' account, this stock is wildly, I'm talking about wildly overvalued. And not only that, they better hit it out of the park over the next several months just to maintain that lofty valuation. Any other stumbles and missteps, and this stock will likely continue to go down. Now, if you like risk, this is the type of stock for you. But when the broader markets are down so much, taking risk like this in these types of stocks, I don't know if you really need to do that. Now, in the most recent quarter, the company bought back about $3.5 billion worth of shares. Look, when your stock is down 46%, maybe not the worst thing to do that. And you see over the last 9 months, they've bought back about $8.8 billion worth of stock. And considering we just looked at the balance sheet that really has almost no flaws in it, I don't really necessarily have a problem with this. We've looked at other companies where the buyback probably should be eliminated almost ASAP. Here, I don't really have a problem with that. So that is benefiting you and probably keeping a small floor underneath this stock. Now, factoring everything in, they've burned through just a small amount of cash over the last quarter, but again, we're on relatively weak grounds when it comes to these financials. Now, during the regular session, stock was down 4.5%. In the after hours after these results, you're kind of bouncing around. You're up maybe roughly 2%. Ironically enough, you're basically back to where you were on this stock when they announced their last earnings. You were right at about $163 per share, and that's really where the stock is right now. There is an area of kind of support resistance right where the stock is, and in the shorter term, the momentum has absolutely been on this stock side as it's up more than 30% just really over the last month or so. You'd expect the dominant trend, though, to take over at some point. And that dominant trend, obviously, with Nvidia and really the broader markets and most stocks, is down and down significantly. I would actually expect this one to meet some resistance here and then start to pull back. You've got some areas of support down here at about 128. If it goes all the way back to the bottom of the channel, retest lows back here at 111. But boy, if it retests the bottom of the channel, that's going to take it to the price target I have on this one, which is roughly half of its market cap. That would put you at about a 7 to 8 times sales on this one and about a 25 forward earnings revenue, which again is still rather rich. Even if you cut this stock in half, it still has a rather rich multiple. Certainly if you start to compare it to AMD, certainly if you compare it to Intel and the other chip sector. Now, at one time, I believed Nvidia deserved a premium multiple as they had 30, 40, 50% revenue growth year over year, and they were coupling that with massive earnings growth as well. That is going to not materialize over the next year. And it is a question mark for me sitting here as an investor if they're going to be able to reaccelerate that like Wall Street expects sometime in the back half of next year. So just for my own personal taste, this one's more overvalued than I'm willing to risk in today's market. On top of that, you have negative revenue growth, negative earnings growth projected over the next couple of quarters. I don't necessarily think that's priced into the stock at the current time. Whether or not it gets down to what I would consider a fair valuation anytime soon certainly remains to be seen. But one thing is for certain, this company is going to have to hit the cover off the ball over the next couple of months just to maintain this valuation, let alone push it even higher. Hopefully you guys enjoyed today's video. I'll be back again soon later this week. Make sure you check in on Friday for the Fang Stock Recap Show. We'll talk more about these Nvidia earnings along with the other stocks that we cover. Good luck with your investments.